So Tom, the VIX positioning becomes a really interesting one, right? So let's say you want to take the opposite view of where a lot of these speculators have built up their shorts on volatility.
Right.
How would you get a long vol trade using options?
I think this is a pretty good discussion, especially with the S&P 500 up 24% so far this year, that divergence, and the VIX almost near 52-week lows over the last week or so as we've hit these record highs. Pull back a little bit today, but I look at the VIX and use it as a hedge. So as VIX goes higher, usually the market's falling. We get some more implied volatility in the market. And how do you take advantage of that? Or how do you protect maybe gains that you've already had in the overall market? And this is what I've got a couple different trades, same basis or thesis behind both of them. And the first one I looked at was just using VIX options. And you can just buy a straight call. What I did was I created a long call vertical. So if the market does pull back, implied volatility rises, you take advantage of that. So maybe some of your positions that you have on, your long equity positions or long option positions that are bullish, this is a way to hedge maybe some of those losses if it does turn around. And buying the 12 calls, which are in the money by about $1 now, and then selling the 20 calls. Take a pretty good spike to get up there. You're paying roughly about a $2.80 debit on something like this, Oliver, on $8 wide VIX call verticals. Now, this will increase in value if the VIX starts rising, if we get a pullback in the equity market. And this is a way to do it. I only went out about 26 days until expiration on that D18th note there, but this is a way to play that. Or you can just buy straight VIX calls if you want to maybe hedge some of your portfolio.
Yeah. Okay. So this is a pretty interesting way. So you're buying VIX calls.
Yep.
Now, you got one other trade here that I want to hit because it's related to this.
Yeah.
But kind of taking a little bit of a different tone on how to do this, right?
Yeah.
Looking at a vertical on the S&P 500.
S&P 500. So same type of theme like I mentioned. If you're planning for maybe a pullback, you're speculating, or you're hedging your existing portfolio, you can beta weight your portfolios to an indice like the S&P 500, or if you're tech heavy, to the NASDAQ 100. If you're small cap based, you can beta weight your portfolio or take a look at all your positions, beta weight it towards a specific indice. And what I did here is with volatility low right now, long verticals make more sense as opposed to selling maybe an out-of-the-money call vertical. So what I looked at was, I went out all the way out to January, so you got about 56 days until expiration. Buying the 3110 puts, selling the 3080 puts. So you're creating a long bearish put vertical. You're already in the money on your long Jan 3110 put. You're paying roughly about a $10 debit on that spread, Oliver. It's $30 wide. So if you get a 1% pullback in the S&P 500, you're going to be below 3080, and then you're going to be at max value if it's there at expiration or any point lower than 3080 to the downside. So beta weight your portfolio or speculate to the downside that maybe this is over and we will see a pullback over the next 2 months. This is a way you can take advantage of it in a low volatility environment because it's cheaper to buy these verticals in that type of environment. Now, I think it's a good speculating trade if you're bearish or if you're hedging your existing portfolio, which might be long the overall market or bullish the overall market.